Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, happy Thanksgiving, happy Black Friday. Welcome to the AJ Brown Show. This is episode 160. Today is November 29th. And with me, as always, the main man of the hour, Mr. AJ Brown. AJ, how you doing? How is your Thanksgiving? Oh, I'm losing you. Oh, yeah, I'm losing you. Can you hear me, AJ? Can you hear me, AJ? Up.
Yeah, I can hear you just fine. This is AJ. Hi.
AJ, how was your Thanksgiving?
I'm full. I'm still full a day later. It was a lot of food. How about you?
Not as much food, definitely more on the drinking side, but
Oh,
I'm not mad about it.
yeah, I
uh,
had some good cocktails and a single malt scotch yesterday, so that's good too.
More friends, less family, so I figured it was a fair trade-off. Waking up today, I saw the markets all new highs again. We're back up to these levels. We ended our pre-holiday session with some inflation news that I think the market looked at and was a little bit concerned with. Seems as if we've alleviated all of those concerns today. What are your thoughts heading into today? What are you looking at?
I mean, let's take a look at that inflation number. I'm going to pull that up on my screen really quick. Um, it wasn't actually, and I think folks maybe blew it a little bit out of proportion. Actually, let's look at some of the stuff that was released all throughout the week because I don't think there was much going on. So consumer confidence always reported in the month that it's for the month that it's reported in. So this is this month, November's consumer confidence, and it's pretty strong. It's a little bit below what they expected, just a tiny bit below what was expected, but definitely higher than last month's. And also, last month was revised higher. So consumer confidence up around 110 or higher, which is we're at 111.7, usually means kind of on the hot side. So that means consumers are not worrying about things. When you start to see it dip down near 100, that's when you start to think, oh gosh, the consumer is in trouble. So I don't think the consumer is in trouble. Now, fast forward to Wednesday, right before the holiday, we got our GDP numbers. This is the preliminary numbers for GDP that, it's advanced, and then a month later preliminary, and then a month later final, and then we move on to the next quarter. So GDP is still, hashing through quarter three numbers, right? But basically no change. So GDP stays the same. Consumer confidence is strong. And then ultimately, I want to let's look at durable goods, right? Durable goods are stuff that's going to last longer than a couple of months. And so new orders, 0.2%, that looks, below expectation, but compared to what it was last month. And so durable goods is reported for October. So comparing it to what we saw in September, I mean, it's up. And even September numbers were revised higher. So people are buying stuff that lasts. This is usually more expensive stuff, higher profit margins for the companies that produce them, but also stuff that doesn't get, replaced often. They're not consumables. They're like dryers. They're like automobiles. They're like, these are things that get maintained versus replaced often. But then when you factor out transportation, which is cars, you see that, again, below expectations and below September's numbers. So now we're kind of focusing on there's been an uptick in car buying, but maybe not those other items like refrigerators, couches, cars, other durable goods, and core capital goods is down. So this is a mixed report for some of those things, meaning that maybe people are holding off on bigger expenditures unless it comes to cars. And cars is a whole different thing. which is why they separate it out. Like cars often have incentives, especially around the holidays or going into the holidays. So they separate. That's why they separate it out from the core capital goods. So people are buying cars, maybe not so much buying other big expenses. But now let's look at that inflation number that you were talking about. So that's the personal income and outlay. So this is everything came in as expected on the expenditure size, right? On the outlays, on spending, right? So spending came in exactly as expected. Inflation for costs of things is at 2.3%, 2.8 for core. That's great numbers, and it hasn't changed. So that means prices that the retailers are spending, what we're spending at the stores are staying stable, and it's right where the Fed wants it to be. What scared people, Sip, was this number right here. Incomes. So incomes, 0.6%. I know I missed the mark there with my drawing. Let me try again. 0.6%. What we expected was 0.3%. And so basically it means that people are getting higher wages, right, than we expected. And so inflation is not just what we see at the grocery store. Although when you ask somebody on the street what they think about inflation, they're going to tell you about the price of gas and the price of eggs and milk. But inflation, when it comes from an economic perspective, is also the inflation of paychecks, incomes, right? Because that's going to trickle down into the price of things. So if people are getting paid more, well, then that's ultimately in a month or two going to come out to the prices that we pay, right? Because if profit margins stay the same, if overhead expenses stay the same, and you raise labor costs, I mean, this is just economics 101. So that's what kind of scared people, was that, hey, even though this is good news for the individual, they're getting bigger paychecks and costs are staying the same, so they'll have more money to save, more money to spend. We know that that will trickle through. So that kind of scared people, but the number isn't that bad, Sip. It's 0.6 versus 0.3, and it's 1 month of data. And so, there can always be an outlier. This is for October. So I think people kind of initially were, there was news headlines on Wednesday about it, and I saw that too. But when we look at the actual chart, there was a tiny dip, but we're back up. And we're only a half day today. We close in about a little less than 2 hours. So, I think people are blowing that off. People are more excited about the spending happening for, Black Friday and going into Cyber Monday and the whole weekend. So, I think that was just a blip.
Yeah, like when you give your version versus what the news pundits and everybody was claiming, it's your version is much more calm and rational. On Wednesday, everyone was like, inflation numbers are still high across the board, da, 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 da. And I would imagine
when you delve, you got to be data driven. You can't listen to the news pundits. But I didn't mean to cut you off. Keep going, Sip.
Well, I was just gonna say that, and then trading before a holiday may have had a little bit, and then sitting at all-time highs. But then to see the complete turnaround today, which I believe is driven by some news out of the Biden administration that they're not going to be as intensive on the chip stuff. So all the chip names are up this morning, leading things up. But still, I mean, we've looked at that 6,000 mark, and we're heading towards what, 6,050. Maybe even today, maybe even next week. So, are you still? Is this helping convince you that this is a long trade heading into the year? Because I just saw a tweet about the annual returns on the S&P for the past like 50 years, and I'm looking at 2024, and I'm like, man, we are just chugging along to the upside. And we don't really want to call tops, but I don't really see one. Like the way you've explained it, things are calm, and I guess it's just a matter of the end of the year. Does that affect things from your experience? This last month of trading that we have?
I mean, I looked through the history of this show, and you guys know, if you've been following this show for a while, that I'm more on the reasonable side. But I'll be the first to admit that the reasonable side for 2024 has been pretty much wrong. I mean, the market keeps going higher, and there's an underpinning that says it shouldn't. But then, look at what happened in the beginning of the week. Remember, last week we were talking about watch the bond yields, right? Bond yields go up when demand for bonds goes down, right? And so, the demand for bonds, when all the news about Trump's cabinet picks, and even Trump getting elected by not only the Electoral College, but the majority of, he got the popular vote, people were going out of bonds, bond yields were going up, and that was something we needed to watch, because that then affects things like mortgage prices and stuff like that. Well, and also bond yields were going up because economists and people who are investing were worried about some of the stuff that Trump had been talking about on the campaign trail with tariffs and things like that. And we can talk about that in a whole other conversation. But the scoop is that he picked somebody for Treasury Secretary that is very much level-headed. And that's kind of a good thing. Immediately when a cabinet pick was announced, the bond yields came down. People started to buy, and they're like, okay, this guy is going to put, some common sense into some of these economic strategies that were talked about on the campaign trail. So, bond yields came down. That allowed equities to go a little bit higher. A little bit more of a calm came out in the market in the first couple of days of this week. So, you look over here at the VIX, which is, as you know, a measurement of confidence versus uncertainty. Confidence if it goes down, uncertainty if it goes up. And for the most part, especially since that whole thing about, is Trump going to be as crazy with the economy as he talked about on the campaign trail? As soon as that kind of relief came out, the VIX just started to move lower and lower. So, back to your original question, there's still something unsustainable about this. And like I said, last week, I went to that multi-speaker event, and a lot of folks who are in a different type of investing and trading than I am, and I sat in on their presentations, had more, reasonable explanations about why we're kind of like a child right before bedtime, having that last burst of energy, and then maybe we're going to get a lull. A lot of those speakers presented good evidence as to why that's going to happen. From my perspective, I still think that's going to happen, Sip. I think that we've got more run up. You look at the Fed expectation for the December rate, and it looks like, it's 2-1 that they're still going to drop rates by a quarter point. So we can pretty much expect, we'll watch as that date gets closer. It's going to be December 18th. So it's still about something like 3 weeks away, maybe a little less than 3 weeks away. But the expectation is still a quarter point rate drop, which will be great for the markets. But I don't believe that 2025 can keep up, right? The S&P rises on average about 7 to 8% a year, and in 2024 it's up in like double digits. It's like in 20%. So there's got to be a calm coming in the S&P where it just goes sideways. And the last thing I can say is, if we come back to the S&P and I overlay kind of my technical analysis, which we always like to do, here it comes. First of all, I'm going to put my rulers back on, and I'll just give you an idea of what I'm seeing from a technical perspective with using my retracement analysis. Today, we're going to be pushing into that green level, right? It looks like we're getting really close. Let's see. We're currently trading at 6,033. As you can see, my green level starts at 6,032. So if we close in that green level, we're going to keep with this definition of having a mature and ideally uptrending S&P 500. So, the retracement, all I can do is say trade the data. And so we're still in a neutral bullish bias here at Trading Trainer, meaning we're bullish with our swing trades, we're bullish with some of our premium trades, but we've still also have some neutral in there so that if things start to go sideways, we're going to continue to profit. So that's what I could suggest to you guys out there, is that there's definitely a bullish sentiment, but that things could start going neutral at any moment here. And so you want to use those trading strategies that profit in both instances, not just don't put all your money in going long, where you're only going to make money if things are bullish. You want to be able to pivot on a dime and be able to make money if something goes sideways. That's what I'm advising all my folks.
Additionally, we'll be advising some strategies, some option strategies that you can utilize to take advantage of, this type of market where we're sitting at these highs. I do, as you're explaining the logic behind some of your thoughts, AJ, I keep thinking about how 24% increase last year, like you mentioned, 20% increase this year. If something happens and we pull back like 5 or 6%, that's going to sound so much worse than it actually is, right? Like a correction like that would probably be good for the market in the long term. But I could just imagine when it happens, everyone's like, the biggest market drop in history. And it's just like a matter of, well, because we're up so high, like we got to pull back a little bit. So I could see that happening. Don't know when, but I think what's great about what you and the community at Trading Trainer does is you prepare yourselves for this, right? Using the tools and premium selling strategies. If something like that happens, that bodes well for the majority of your strategies. If it doesn't happen, well, you keep creeping along. You keep collecting those paychecks like their income. And so that's pretty much, why you created the program. You wanted to educate people, why we do the show, so that we can kind of go through these strategies live in person, I guess, virtually. But with that, we do want to give everyone an opportunity to head on over to your free daily workshop if you want to get a little bit more in depth on these 4 strategies. We've got AJ's quick links in the chat. This will give you access to all AJ's goodies, his free indicator suite, the social channels, the link to the workshop, more about Trading Trainer as a program in general, and coaching. So if any of these things pique your interest, head on over there, sign up, show some love, hit that follow, hit that like, hit that subscribe button. We are streaming live, so if anybody watching has a name that you want AJ to run through, today seems like a good day to hit some of those. So throw it in the chat. Otherwise, we've got a lovely one of our favorite guests on the show. We've got a really interesting question for our topic of the week. And with that, we'll take a short break. We'll be back in a few seconds to go over that. And then we've got AJ's pick of the week, our speed round, and then we'll let everybody get back to their Black Friday shopping and leftover eating. Sit tight. We'll be back
Leftovers.
In a few seconds.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
Well, we went with the Black Friday theme today, and it seems like Black Friday isn't what it used to be, right? Like I know that some campaigns we've been running Black Friday stuff for like a week and a half. So maybe not the wild Friday that we're traditionally used to, but definitely some sales out there and some football today. We got some Black Friday football and half day trading. So everyone's going to be, wrapping up these positions and heading back to the family. So, AJ, with that, we've got a really good segment of the week, topic of the week, and this is from one of our favorite guests over time on the show. Manny. Manny is 11 years old, about to be 12. Started diving into the world of options, I believe, with some guidance from his parents, and asks a lot of good questions that a lot of our other viewers and people learning to invest ask. And so, AJ, this week, Manny wants to know, when you're referencing some of the topics that you discuss, what does EOD trading mean? What
Mhm.
are other kinds of similar verbiage to NEOD? And, well, I guess EOD stands for end of day trading.
End
So
of day.
what is it, and why is it important, and why do you focus on it a little bit more than maybe some of the other people out in the landscape?
Oh, that's a great question, Manny. And I'm glad to hear that you're still with us and still, Manny, just on a side note, that's one of the most critical things for being a successful trader is remaining consistent with it, right? And sticking with it. A lot of folks can't, don't realize the success in trading because they don't get instant gratification right when they first start, and they don't stick with it over time. So I'm glad to see you're still around. This is like 2 years that you've been checking in with us, and glad to hear that you're about to turn 12. Okay, so end of day trading means that you are doing stuff after the market closes. You're doing your analysis, you're checking things out, and majority of traders are end of day traders. I mean, look at one of the most popular trading shows on TV. That's the Jim Cramer show on CNBC. It's in the evening, and it's in the evening for a reason, and that's because folks have stuff doing during the day. The other types of trading that you might hear about is like day trading, even high frequency trading. So day trading is people who are actually, in front of the computer on the phone during the day, doing trades, in and out within a day, doing trades real time like that. End of day trading typically is people making decisions after the market is closed, and then sending their orders the next day, either through a broker who decides when during the day to make that happen, or more recent, we've gotten these like trading apps that you can put contingent orders in place, where a couple things have to happen during the day and then your order is in place. Or you could just place your order in the morning during amateur hour, when a lot of folks who are getting in, placing their orders after they do the analysis the night before, and then they go off to work or go off to do whatever they're doing during the day. So that kind of defines an end of day trader versus a day trader who's there during the day and possibly is doing positions that open and close in the same day. High frequency trader is somebody who basically is buying very powerful computers, more powerful than the computers that run the exchanges, right? And so high frequency traders have really good internet connections, and they'll watch the market, for instance, in the Pacific Coast. And if a trade happens which changes the price in the Pacific Coast market, they come as fast as they can with their fastest computers and fastest connections to the New York Stock Exchange market and do that trade before the Pacific Exchange reports back to the New York Stock Exchange. And so they're basically doing arbitrage very quickly. And really, that type of trading has changed things. And there's been all sorts of government regulations, but really it comes to how much money do you have to buy the fastest computers and fastest internet connections. But because of that high frequency trading, we've had to all adjust and make kind of things different because of that, just like we've had to adjust because of the proliferation of exchange traded funds, right? That's created more correlation in the market. So I keep getting on tangents. The scoop is people do end of day trading for a couple of reasons, right? I do it because of a lifestyle thing, right? I always wanted to replace my day job, right, with something that wasn't going to be a day job, right? My whole thing was I wanted my money to work for me so I didn't have to do that because I really like my time and I really like doing fun stuff that I don't have to worry about getting paid for during the day, right? I I had some wake up calls in my 20s and my 30s that made me realize that there's only so many hours that we all are given in this world and that I wanted to use my stuff, my hours like as wisely as possible. So that's why, I do my stuff in the evening when everybody's going to sleep. And then I let, computers do it during the day. I use those conditional and contingent orders to place my trades during the day. So I don't even have to be there. So mine's a lifestyle reason. But another reason why people do end of day trading is because of just the data, right? The data to get end of day trading is really relatively inexpensive. Anybody can afford it. You don't even need a brokerage account. Most of it's free. You can go on to Yahoo Finance and get end of day data free. But real time data that if you're going to be a day trader or a high frequency trader is very expensive. And so some people who are just, getting into the markets to be a trader, they're going to focus on end of day trading just because the barriers to entry to be an end of day trader are not very high. So these are kind of the reasons why people focus on end of day trading. But again, I just do it because number one, technology allows us to do it now, right? It's really easy. Back in the day, because I've always been an end of day trader. And back in the day, like 20 years ago, you know what I had to do? I had to either in the beginning, I had like some young cousins who, they were, you know, hanging out at home. They weren't like doing stuff during the day. They were doing my trading for me. And then when I got more professional, I was hiring people during the day to do those trades for me, those conditional contingent orders. But now they have these cool, you can actually place contingent order. You can say to the broker, hey, place my trade only after, 1 o'clock in the afternoon and make sure that prices are going higher. Basically the follow through that you saw the evening before, when you get a signal, an end of day signal, you want to make sure tomorrow when you trade it that it's following through. So all of that can be automated now for free, right? So end of day trading I do for a lifestyle reason, and that's why a lot of my folks do it is because they want to do other things, right? They either want to spend more time with their family or they want to start getting into those hobbies and things, art, whatever it is that they want to do during the day. And then a lot of folks, do it because they really love what they do in their career. Like I have a lot of like doctors. I have one guy who's really into solar energy. So during the day, he just wants to focus on solar energy. And then at night, he spends a few minutes, if not an hour, on his trading, right? So it's something that instead of, being so focused on trading that's your life, instead, most of the folks that are end of day traders, they're using trading as a means to an end, and then they've got stuff that they really care about during the day. So I hope that makes sense on why people are attracted to being an end of day trader.
And in the news most recently, I don't know if you've seen, but there's been speculation of like some of the hours changing and some of the exchanges going more 24 hours or whatnot. So I could imagine that this end of day in time might kind of become a novel concept, right? It's just because of the ability for markets to stay open, right?
Yeah,
But like you said, it's definitely a lifestyle, and there is some psychology probably behind where a stock or or an asset ends at the end of the day, and then where it begins, and
absolutely.
some math that smarter guys than me are back there working on. But
I mean, the exchanges, you have to admit, so the exchanges have changed a lot of things since they became public companies, which was like 15, 20 years ago. Um, all of a sudden the exchanges have to show a profit. So it behooves the exchanges to become 24-hour exchanges. But for the investors, there is that psychology about end of day and then pre-session, after hours, and there's a lot of analysis. So if the exchanges were to go to 24 hours, that would change a lot of investors would have to recalibrate. And I almost feel like investors might petition those exchanges to not do that. I don't know. We'll see. Everything's changing. And you just have to roll with it, which is what we do here at Trading Trainer. We basically take what's given to us and we figure out how to make profits on it. And that's it.
Yeah, because some of these like overnight moves, pre-market moves can be really significant, like really big. And it almost defeats the purpose of having an open, like if we're going to make the entire move before trading opens, it's kind of like, well, where's the move, right? So
and that's always something interesting. So a lot of that gives us intel. People who analyze the market, when we compare what happens after hours, because we know right now kind of the demographic of who the after hours traders are versus who the regular traders are, normal hour traders. And so you can kind of understand the differences by comparing and contrasting those. So if you get rid of those, those timelines, it would make it a lot more difficult to understand what's happening when and how to play that trade. So I think a lot of investors might, bark at the idea of removing that kind of analysis.
All right, for sure. Good topic. Thank you for that once again, Manny. A little bit of a breakdown of end of day trading and why AJ likes it, why we bring it up on the show and some of our examples. So, Manny, hope you enjoy your day off from school today. I imagine nobody has school today. Yeah, thank you for tuning in. All right, AJ. So we've got these market highs. We've got our options trading strategies. And so now the people want to know this week, where do you see a potential opportunity? And so in my notes, your pick of the week this week is Seagate Technologies, ticker symbol STX. I'm actually familiar with this company. I use their product. They build hard drives and stuff, and where you can pack in gigabytes and terabytes of data.
Yeah.
What do you like in Seagate Technology?
Well, so Seagate Technology is trading at a higher dollar figure. And so we have to do a different trading strategy for premium selling. So I'm looking at a 3-month chart, but I'm going to zoom out to a 6-month chart here. I love that pattern. I love those sideways choppy patterns. Those, to me, whenever I see them, I see opportunities to create ongoing income streams, which is just the cat's meow when it comes to trading, right? And Seagate is a company that's been around for a while, since the whole PC revolution of the 1980s, 1990s. They've been good at, embracing solid state drive technology versus actual hard disk magnetic storage. They've been, keeping apprised of the latest technology. So you can tell they're doing well. They've got great earnings numbers. They give a huge chunk of money back to people who own their stocks. If you think about it, if you just simply own Seagate stock, you buy it at where it's trading now, around $100 a share, you're guaranteed a 3%, 2.1, 2 point, something like that, 2.8% return just by owning the stock. And sometimes that's even better than a savings account. So the people who are investing in Seagate don't necessarily care what happens to the stock price, so long as it stays, roughly around $100. They don't care if the stock goes up in price. It's a well-run company. They're going to earn better than they would by putting their money in a savings account. So Seagate is like my ideal pattern of a company, of fundamentals checks it, technicals checks it. The only thing is Seagate is trading at a little higher price. So unless you have a multiple $100,000 portfolio, you probably don't want to use our traditional premium selling strategies on Seagate because it's expensive. So the alternative is what I call legging into a condor. And that's a lot of like nerd geek speak. Basically, all we're going to do is put vertical spreads on at bottoms and tops. Now, the key is, and I've seen people totally have their fortunes obliterated because they don't trade vertical spreads correctly. And more specifically, they don't manage the risk of vertical spreads correctly. Realize that a vertical spread could go from profit to full on 100% loss in a snap. And so when you size your position, even though these things are super inexpensive, vertical spreads are known for being inexpensive, you only want to invest as much of your portfolio as you're willing to lose. So if you're only willing to have any one particular trade lose to your portfolio, say 2, 3, 4%, then don't take any more than 4% of your portfolio, 3%, 2%, whatever that number is, and buy these things, right? I've seen people who put like half of their portfolio into these because they're saying, oh, these are so cheap, right? So I'm just going to buy a bunch of them. And then they go to zero and they lose half their portfolio. And they don't correlate that at the time of purchase because for some reason people are very optimistic and they look at what the win rate is and not what the ramifications of a full loss are. But understand that vertical spreads, when they lose big. So make sure you only invest the amount that you are willing to lose because you could lose it. With that said, I would do a vertical spread right now. We got a nice signal back on November 20, and then it got follow through the next day. But we've actually had a little bit of a pullback, somewhat of a double bottom. And so, not today, but maybe in the beginning of next week, buying some Seagate bull vertical spreads. And I don't care, there's this big debate on credit versus debit spreads. And if you don't know what I'm talking about, it doesn't matter. They're synthetically equivalent. They're the same position. So whether you want to do a bull call vertical debit spread or a bull put vertical credit spread, it doesn't matter. They're the same thing. They work out mathematically. If you do a credit spread, you're going to need a margin account, but whatever. That's a whole other discussion that really comes to no, I've had people who stomp up and down and say credit spreads are the only way to go, but I then show them mathematically that debit spreads are the same thing. It doesn't matter. Just a bull vertical spread, whatever variety floats your boat. I could see putting one of those on, like a 195 bull vertical spread, and then allowing that to appreciate. And basically, every time we get a strong top signal, we'll go ahead and close that bull vertical spread, and we'll open a bear vertical spread. Again, the variety doesn't matter. And we'll just oscillate back and forth between those two as this goes through. And if you're really close to expiration, then you may not have to close the opposite vertical spread before you open the other one. You may just let time decay, because this is also going to allow that timer to work for you. All of these vertical spreads you're going to do are near term, meaning 3 to 5 weeks to expiration. So that's what I'm looking at, Sip. I'm looking at a bull vertical spread expiring December 20th, third Friday of December, probably 95, 100. It's not going to be today on this shortened day. This shortened day, by the way, has hardly any volume, meaning there's no traders. So despite the market being up, it's just a few voices speaking loudly. So I want to see what's going to happen on Monday. But if I get follow through on Monday, if I haven't already placed a trade on Seagate Technologies, I'll be placing a trade like that.
Awesome. Two interesting facts that I stumbled across. Headquartered in Dublin, Ireland. I was kind of surprised to see that. $7 billion in revenue. So they've got a pretty good product,
You
nice
know,
little customer base.
I have personal. So when I worked at Hewlett Packard, I worked at Hewlett Packard in their California Santa off of Campbell Avenue, Santa Clara, California campus. And that campus was the manufacturer of a device using lasers that hard disk manufacturers back in the day. And now I'm dating myself, but basically our only customers were Seagate, Western Digital. Who else made hard disk? There was only like 5 customers, and there was no reason for Hewlett Packard to move the manufacturing of this one device because we only made like 5 a year, right? But they would go to these companies, and Seagate at the time was headquartered on my drive home, because I would drive home from Silicon Valley, Santa Clara, San Jose, all of that, to the beach, because I never wanted to, I just got through talking about my lifestyle. Even when I had jobs, I didn't want to live in like nerd, Silicon Valley. I would always drive over the little mountain. It took like 50 minutes to get to the beach, Santa Cruz. Well, I guess the people at Seagate thought the same thing, because on the road down to Santa Cruz was the Seagate headquarters, and it was very cool looking and all that. But I remember when they decided to pick up and move to Ireland. Ireland has amazing tax for big corporations. A lot of big corporations moved their headquarters to Ireland because Ireland was like incenting companies with tax, benefits, like zero corporate taxes and stuff. So Seagate moved everything to Ireland. And so that's my personal experience with Seagate and Hewlett Packard. That was a whole nother invention of myself back in around 2002. So we're talking about 22 years ago, but very interesting story.
Yeah. And on that topic, since you brought it up, moving into our speed round, one of the names that came up from our user base this week is actually Hewlett Packard. So Joe in San Jose must be in the space and looking at Hewlett Packard, and he knows that AJ has some knowledge on it. So he wants to know, AJ, if there's a play in Hewlett Packard.
Okay, so Hewlett Packard, interesting. So Hewlett Packard's changed a lot since I was there. They had Agilent. I actually broke off from Hewlett Packard and worked at Agilent for many years, which was an interesting play. That was right when Hewlett Packard merged with Compaq and then broke off Agilent. Then they broke off a whole bunch of other pieces. Agilent broke up into Keysight and all these other companies. Hewlett Packard has 2 stock symbols, HPQ, which is the one I think you're looking at, versus HPE, Hewlett Packard Enterprises. So Hewlett Packard Enterprises, more of their high-level services where they go to big companies and they are providing, server upkeep and, things like that, versus HPQ, which is printers and, actual products. So HPQ literally just had earnings. Let's see. Earnings was November 26th. So today's November 29th. What is that? Tuesday? And that was after market close. So if you wanted to do an earnings trade, you would do it on Tuesday, and then you would take it off on Wednesday. And I see where the market opened and then it popped up. So even if you took it off, there was a little bit of change in price. You probably could have still made some good money on the volatility crush because, depending on where you got out, or, you can hold those positions if there's a movement in price, because a lot of times those movement in price are recouped. I can see today that people are trading HPQ higher. I'm not sure where you're coming in, Joe from San Jose, whether you tried to do an earnings play. If you did and you haven't already gotten out of it, if you didn't get out of it on Wednesday, you could probably wait a day or two and allow price to resume back up here near 38, 39, and that would allow you to really capitalize more on the volatility crush rather than the price change, which works against you. But the other thing you might be looking at is that earnings caused us to get down at a low really quick. So, Joe, if you're thinking what I'm thinking, that you might want a good opportunity to buy some HPQ, that it's at its lower price, I'm thinking the same thing. In fact, let's jump in to our options lookup tool. You guys know this is one of my favorite tools that we just came up with. And let's look at HPQ really quick and see if there is, if you don't want to be buying the actual stock, if you want to see if there's a stock substitute, you could use our options lookup tool. You simply set the strike price to all, and you click this box that shows price components. And what we'll see here, if you want a stock substitute, you probably go like 6, 7, 8 months out. So maybe we're thinking, I like these June options. Let's look at the June options. Let me get this bonus menu out of the way. And I'm looking under this call side, and I want to see an external or extrinsic value percentage somewhere around 5% or lower. But I also want to look over here and see that the bid-ask spread isn't too far apart. So I'm looking at this 23 or this 25 strike price. So here's the scoop. You could either be buying this stuff for $34.66 a share, or you could buy something that's almost exactly the same for $10.13. The only difference is that this is an option and that's a stock. This expires next June of 2025. The stock doesn't expire, but when the stock goes up $1 from like $34.66 to $35.66, this is also going to go up $1. So this is going to go from $10.13 to $11.13. But because you invested a lot less, it's going to, be a higher return on your investment. It also the leverage works in both directions. So be aware of that when you're sizing your position. But I could see using this June $25 call as a substitute. And that was really easy to find using our options lookup tool, buying that. And then if it goes up like it did right before earnings, even if it only goes up to 37 or 38, that's when you can create income off of this. You could sell your call, buy a protective put, and then roll out of the protective put. You'll make income by selling your call and rolling out of your protection, and you rinse and repeat. You can do that either on the stock or on the cheaper option substitute. So yeah, I see what you're seeing, Joe. And I would get into your initial covering position again, buy some stock, buy that substitute call option, and then turn it into an income position in a week or two from now.
Yeah, hopefully continue to ride this technology boom that we're seeing in the NASDAQ, really, and some of these other names. So thank you for that, Joe. Moving on to our second name, a name that we cover on the show a lot, a name that we like to look at to follow along with the commodities. And Tony from Boston wants to know your take on Eldorado Gold, ticker symbol EGO.
Yeah, we totally featured this a couple weeks ago as one of my picks of the week. And I guess you were wondering when you sent this in, it was rallying like I said it would after that signal. We got our signal, and then back to Manny's question. This is our follow-through day, and my automatic trader, my conditional contingent orders would have filled. And then you might be saying, oh, but it pulled back. But you'll notice it pulled back, and it did give us that opposite signal, but that opposite signal never got the follow-through. That opposite signal, Tony, was canceled out today. So that opposite signal, basically, we're having what's called a double bottom. And a double bottom is an awesome opportunity. It basically is saying, hey, this bottom is for real. And if you missed this trade, first of all, if you didn't miss this trade, I'm sorry you had to white knuckle it, but the pattern is telling us that it's getting stronger and stronger. Double bottoms are stronger than single bottoms. So you should stop white knuckling it and breathe a sigh of relief. But also, if you missed the opportunity, hey, second chance, man. So I'm still sticking to my guns that I had when I featured this a couple weeks ago. And that is, I want to be buying Eldorado Gold. It's cheap enough to be buying the shares. I think we found a couple weeks ago that you could use an option substitute. Go out to June, use the options lookup tool the way I did for Joe in San Jose on HPQ. You could use that on Eldorado Gold. Find yourself a substitute option. This is what I would be doing. And if you did get in and now it's giving you a double bottom, if you want, do some dollar cost averaging. You could, this is an opportunity to increase your position on EGO. And so I would do all of the above, because by owning EGO and having this appreciate, we're looking for it to appreciate above 1750, ideally above 1850. And then you sell premium buy protection, create that income. That's what Eldorado Gold is all about.
Yeah, I this week I saw a lot of new or headlines about how some of the commodities have pulled back this November. But in general, pretty much on the move up for the year, just generally speaking. So thanks for that, Tony. All right, moving on to our third and final name in our speed round. Canadian Solar, ticker symbol CSIQ, Jacques in Ottawa, Canada. And when I saw this, I thought of some of the rhetoric this week with the tariffs, right? So like I saw some funny memes because Trump was like, we're going to tariff China 60% and Mexico 30% and Canada 30%. And I saw these memes where Canada is like, whoa, what do we do? Why are we getting blamed for this, right? And so I'm curious as to any of the names in Canada, how they're going to play out. So what are you seeing when we pull up Canadian Solar? Are you familiar with Canadian Solar?
No, not so much. But and we should definitely on one of our shows talk about, this whole discussion around tariffs and what it would do to the economy. Or maybe I'll create some shorts on that or something for folks to watch. But in the meantime, I'm not familiar so much with Canadian Solar. But the scoop is I'm looking at the pattern, and I'm looking at, this company is coming up with earnings. So I would definitely get through earnings. Earnings is on December 5th. So let's not do any kind of trading on this unless, it looks like the last time we did earnings, it was like no great shakes. When I'm thinking about an earnings play, Jacques, I often like to go, at least the last 5 earnings back. 1, 2, 3, 4 live earnings, including the one that's coming up. And I like to see, what happens the day after and the day before. And I'm not seeing, this was the one a year ago, not much change. If I look at close to open, not much change, because I would be trading close to open, basically. Same here, close to open, not much change, not much change. So first things first, Jacques, there's still time. What we, do your analysis over the weekend. What we wind up doing is December 4th. Well, when is the earnings? Let's see. Before market open on December 5th. So December 4th, if you do your analysis, you pick your, horizontal spread, your calendar spread, strike price. December 4th, towards the end of the day, is when you buy the calendar spread. December 5th in the morning, usually, right after or right at the end of amateur hour is when you sell your position, unless something, crazy happens, and you have an earnings play there. So, it might be pretty cool. I might think about this and do this with us. I might be featuring next week an earnings play on CSIQ. So that's the earnings play, and that's definitely there, knowing that we have the earnings next week. But we could also think about a premium trade, because we're at the bottom of our channel and we got a reversal up. So once earnings is come and gone, if we're still trading below this, this center zone by my magenta lines here, if we're trading below $13.66, we'll look for an opportunity to buy some Canadian Solar. This is a great price for this stock, between $12 and $13. That's where our target would be. Get some of this stock If they have, let's see, let's use our options lookup tool really quick and see if there's a substitute. CSIQ, just hit enter. Boom. It's thinking. There it is. We'll go out. For liquidity, I probably will look at, the June option. That'll be good. It's not as liquid as Hewlett Packard, as we would expect. The June option, I don't see a good substitute. So you're going to be buying stock. Let's look at this April option. The April option has a little bit more going for it. January. Okay, the January option is a little bit better as well. So it's not as liquid. I would probably buy stock, and I want to buy stock in 100 share increments. So instead of, $12.74, I'm going to be buying 100 shares at $1,273 for 100 shares. And then once this creeps above this $15, maybe closer to $16 or even $17, that's when I want to sell my premium, turn this into an income stock. And it looks like it would be a good income stock. And I see my fast MACD is giving me great signals. So just trust the fast MACD as to when you apply those income trades. And that's what I would do on Canadian Solar. Earnings play, premium play.
And then keep an ear to the tariff stuff, because we don't know what's going to happen there. But we definitely need to get something of that discussion onto the show, just because I know you probably got some really good insight on that, AJ. But that's Canadian Solar, ticker symbol CSIQ.
Do your due diligence. I think everybody should do their due diligence. So we're looking at it strictly from a technical chart perspective right now. Make sure you go back and do at least a minimum soft data analysis. Look at fundamentals. Make sure it's a good company worth selling premium on, or worth holding the stock on before you do any of my strategies on it. That's like a given, and hopefully you've done that before you've submitted those in to me. And if you haven't, go back and do your homework.
And as always, if you're interested in getting access to that indicator that AJ references all the time,
Fast MACD,
surprisingly, that's still one of our top videos out of all the YouTube videos. Is people want to know how to utilize your MACD, your fast MACD, and then if you become a member and you join the Trading Trader community, you can get that indicator on your charts to kind of help the process and get you those buy and sell signals. So thank you for that, Jacques in Canada.
French Canadian, I can tell.
I would guess that as well. Yes. All right. The links to all of AJ's stuff is in the chat. Our quick links: the YouTube page, TikTok, Instagram, the free workshop, the daily, the indicator suite, learning about the coaching. So if that's something that you guys are interested in, head on over there. Otherwise, AJ, we're going to be, the market's still cranking on up. We're going to be closing here in the next 2 hours or so, heading into a big, I would consider it still, holiday today, right? Black Friday. And then, the weekend. So, any final words as we head into the end of, or the start of Black Friday?
Just have a good rest of your year, and I hope you had a great Thanksgiving. But a lot of folks are trying. Sometimes you just have to step back and you look at, like I'm looking at a year-long chart here. Look at like a year, look at 2 years, look at 6 months of chart. And don't trade based on what the talking heads are saying, right? Because otherwise you would have been whipsawed all day Tuesday and Wednesday. Take a step back, like Sip was saying. If the markets pull back 4%, 5%, That's actually not a big deal. Look at what has happened over the last year. We were down at 4,500 in the beginning of the year. We're at 6,000. We've gone up like a huge amount in just a year. So a little bit of a correction won't kill your portfolios. Don't listen to the talking heads. Analyze the data, and you'll be fine.
That's right. And as always, feel free to hit that like, hit that subscribe, hit that follow button. We truly do appreciate it. I think that's all we got for the folks today, AJ. Thank you once again for your time today. Enjoy the rest of the weekend with the family, and we'll catch everybody next week.
Take care, everyone.
For tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.